Welcome to the monthly 3-Edge View from the Edge for December 2024. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. And as we do each month, Eric and I will provide our most recent outlook for the global capital markets, which, as you know, is based on our proprietary 3-Edge research model. So where are we? Well, we have fewer than 3 weeks remaining in 2024, and with only a few small bumps in the road along the way, U.S. equities seem to be on their way to a very strong year of investment performance. However, the same cannot be said for the bond market. U.S. Treasuries struggled again in 2024. And meanwhile, thus far in 2024, gold has experienced a stellar year of performance, even outpacing, at this point anyway, the performance of the S&P 500 thus far in 2024. So let's get started. Let me bring Eric into the conversation, see what our model is indicating, and see what might have changed since the prior month. So Eric, why don't we begin having you take a look at our asset class matrix and see if there's anything that has moved around.
Sure. Yeah, we see not a lot of movement this month. We had seen a bit more, a few assets dropping down a peg last month. Here we are. I think the notable things are European equities moving up to that mixed or neutral spot. We'll get into the details on why we've done that. And then we have commodities. Just moving down, matching gold in that, slightly positive spot, just above neutral mixed.
But otherwise steady state.
Otherwise steady state.
All right, great. So let's dig into the major asset classes in detail. Why don't we begin with equities? And as always, we'll kick it off with the U.S. equity market.
Yeah, the model, the research is maintaining this positive outlook for U.S. equities. U.S. equities have had quite a year to date through mid-December here. The S&P 500, it's up over 28%. It's now neck and neck with tech stocks, the NASDAQ 100, another popular index, up around 29%. If you were to take an equal weight version, that is an equal weight of the S&P 500, every stock gets the same weight in the index, that's up only 17%. Mid-cap stocks up 19, small-cap stocks up 15 to 17%, depending on the index you look at. So great year all around, but no doubt the real outperformance has been driven by a handful of those tech stock winners. Presumably when a correction comes, and it has been an unusually long time without even a 10% correction, it may very well be these tech names that take the brunt of it. So the diversification away from tech names has no doubt hurt performance, but maybe what helps in the next correction. All that said, the model is finding U.S. equities overvalued, as we've said for some time, but the potential for declining long bond yields, and more importantly, the market anticipation of a decline in the short-term rate following the Federal Reserve's FOMC meeting later this month. These are positives helping the model to continue to want to allocate here. As we've all witnessed, an overvalued market can and has gotten even more overvalued.
Absolutely. So let's shift from the U.S. equity markets to ex-U.S. equities, beginning with European equities. What are we seeing there?
Yeah, European equities, they've rallied strongly recently following a recent high near the end of September. On the year, European stocks are only up 5 or 6% through mid-December. Now, if you look at Germany-focused stocks specifically, they're up about 14. So still decent performance there, but underperforming the U.S., no doubt. There are problems with European stocks. There's the potential for growth even before the Trump re-election, and now the anticipated tariffs that come at a very inopportune time, right? And this is hurting the economy there. This past week, the European Central Bank, the ECB, they cut short-term rates for a third consecutive time to help with this weakening economy, and there's possibly more to come. And still, the yield curve remains inverted. So despite all this negativity, the model research does show some hints of green shoots via behavioral momentum or FOMO, fear of missing out type of factors, which suggest the potential for shorter-term upside movement. So taken all together, more of a mixed neutral outlook here in the short term.
All right, great. Let's shift gears and head over to Asia. Look at Japanese equity market. What are we seeing there?
Yeah, similar to European stocks, Japanese equities have rallied since the end of November. They're up around 11% on the year through mid-December. And on a currency hedged basis, up around 25%. So that really shows the weakness the yen has experienced this year. Also like Europe, the shape of the Japanese yield curve, as we measure it, is not sufficiently steep enough to be a positive contributing factor. But the trend, albeit quite slowly, is that the yield curve is heading in more of that steepening direction. So that's a positive, but it's a quite small positive, given how slow that those things tend to move. So taken all together, still a negative outlook.
All right. And what about the emerging markets, China in particular? What are we seeing there?
Yeah, Chinese equities have had a roller coaster for a year so far. Down over 10% just through mid-January and early Feb, only to be up on the year almost 50%. It's right, 50% by early October on the idea of a government bazooka stimulus kind of program. That fizzled out real fast, though. Then you had a couple of additional stimulus announcements, one in November, one in December. So it's up about 20% on the year at this point through mid-December. The most recent December stimulus announcement served to boost that equity market, but then it gave back a chunk of that gain. So yet again, investors seem skeptical about whether the government's announced plans would be sufficient to get the economy going again. In general, a continuation of interest rate cuts by the Fed in the U.S. should be a positive for China and emerging markets more broadly. But a concern remains, which is the potential for the U.S. dollar to continue strengthening, which kicked off in a meaningful way following the results of our presidential election here. If this continues, this could be this headwind for foreign governments and corporations in the emerging markets who often borrow and also must repay their debts in U.S. dollar terms. So mixed outlook for the time being.
It was interesting to see the most recent announcement of the Chinese stimulus. It worked for one day, right? It went up for one day and then came right back down. So it's interesting. Last equity asset class would take us over to India. What are we seeing there?
Yeah, Indian equities are up about 13% for the large caps, 20% for the small caps through mid-December here on the year. While the long-term growth outlook remains positive, nearer term, the outlook's a bit more mixed. We have seen some widening credit spread measures. There's been a slowdown in market momentum and rate of change of momentum factors, and an uptick in inflation. So all of these have combined to generate a little bit of concern here in the short term. Mixed outlook for now.
Yeah, I mean, it's amazing over India. I think that demographically, they probably would be the most attractive country. Just what percentage of population is under 25 years old, but it's not a clear path. It's up and down, all these things going on. Yes, interesting. All right, let's shift our attention now to the bond market and the interest rate environment, starting with the U.S. Treasury market.
Yeah, we've seen shorter-term Treasury yields have declined further. Expectations of a Fed cut later this month, like we mentioned. The yields on longer-dated U.S. Treasuries have actually begun to move a bit higher, so that's negatively impacting the price of intermediate-term Treasury bonds. So in the short term, this just continues to be supportive of the same position we've held on to for some time, fixed income investing with shorter-term maturities.
Yeah, and that's worked really well for us for an extended period, keeping duration short. Thank you. Corporate bond market, I know that we've had historically very narrow credit spreads. Is there any change there, the model showing?
Yeah, same outlook here. Credit spreads, they are at historic tights. So making any additional yield over a risk-free rate from treasuries just doesn't seem warranted given the risk that one has to take to invest in credit.
All right, let's look at hard assets or real assets, gold and commodities. And why don't we begin with gold, which, as you mentioned, has had a stellar year.
Yeah, gold's been one of the best performing asset classes year to date. A metal that sits on a shelf and gathers dust. It's up around 29% on the year through mid-December. That's keeping pace with the S&P 500. The medium to long-term outlook remains favorable, right, for gold due to continued geopolitical conflict on multiple fronts, including the most recent geopolitical uncertainty brought on the recent fall of the Assad regime in Syria. In addition, we've been reading reports of the Chinese government is once again adding to their gold holdings, and so that's rising real rates, that is inflation-adjusted interest rates, and continued strengthening of the dollar are serving as these headwinds to keep a kind of a price lid on gold in the near term. So we've seen it trade a bit sideways since the election. So overall, the outlook is slightly positive short term and much more positive in the longer term.
All right. All right, and how about commodities? So, what's the research indicating there?
Yeah, commodities have been broadly speaking, have been fairly flat on the year. Now if you carve out just say agricultural focused commodities, a basket of those, that's up over 30% on the year. So you got to focus in on what you're looking at in the commodity space. The prospects for a continuation of Fed rate cuts, the recently announced additional monetary and fiscal stimulus from China that we were just talking about, that all of this could be supportive of higher commodity prices in the months ahead. But like we just talked about for the case with gold, shorter term headwinds of that strong dollar, that may hurt that outlook in the near term. So similar to gold, slightly positive outlook here in the near term.
Excellent. All right, great. Eric, thank you. That was very clear, concise update of the major asset class groups as we head into the end of the year. So that will do it for this month's 3 Edge View from the Edge. Eric and I will be back again in early January 2025 with another edition of the monthly View from the Edge. If you'd like a hard copy of the View from the Edge newsletter for this month of December, you'll find that on our website, and that's 3edgeam.com, the number 3, followed by edgeam.com. As a reminder, all of our video content is always available on our YouTube channel. If you think someone might benefit from our videos, feel free to share them. And if you appreciate these weekly videos and you would be so kind as to subscribe to our 3 Edge YouTube channel, we would be most appreciative. So, on behalf of Eric and everyone here at 3 Edge, we wish you and yours a happy holiday season and all the best for the coming year. And last but not least, thanks for listening.